If you look short term, perhaps technology had run a little bit too far as a sector overall. Expectations were pretty high, hard to meet them. Perhaps leadership starts shifting a little bit more towards financials, for example, where their sentiment had gotten very, very negative. It felt like yield curve inversion was a foregone conclusion, which we're finding out perhaps it's not. There are other global central banks changing pace. Right. Long-term yields can drift higher a little bit from here on out. But longer term, stretching that lens a year on out, we think there's actually room for both.
Well, that's a great point, because those are the two major themes we've been watching this week. Watching yields move up across the curve, as it sounds like the BOJ may start to rein in liquidity a little bit, and maybe that's a precursor of things to come. So maybe the Fed's not so far out in front of everybody else. You're looking at the 10-year back at 3% almost.
That's right. I think they are certainly much further along the process, but I do think that there are other central banks joining the process very, very slowly, certainly. But I think a lot of attention over the past few months anyway, a lot of attention and confidence has been on the U.S., right? A lot of confidence on U.S. growth, on the direction of U.S. monetary policy. Well, guess what? Things aren't that bad around the world either. They're actually pretty good in terms of growth. And so other central banks are joining the pack as well, slowly but surely.
Did I overstate it by saying other central banks may be coming along, Mohamed? Because I will admit, signaling from the Bank of Japan, we're not hearing anything like that from the ECB.
I think we're changing paradigms. Okay,
and we're not in the new normal anymore?
No, we're not.
Oh, the new normal's over.
Oh, that's big.
And global liquidity is receding slowly. The Fed was first. It's a surprise to me and to many people that the Bank of Japan may be second. I don't think they will be, by the way. I think you'll see them do something small, but not too big. I think more generally, you've heard me say this for the last 5 months. It's no longer about massive liquidity coming in. It's no longer about synchronized pickup in global growth. It's about divergence and dispersion. Divergence in economic and corporate performance and in technical influences, and dispersion in asset price performance. This is a great time for stock picking. This is a great time for playing the yield curve. Right, and this is a very different investment paradigm from a year ago.
So give me my new catchphrase. If it's not going to be the new normal anymore, what is the new thing that I can hang on? Because you created that, and we've been using it for the last 10 years.
So it's divergence. We're going to see big divergence in economic performance.
That is not as catchy.
I know it's not as catchy, and it's not about creating something that's catchy. It's about making sure that people don't fall in love with the wrong paradigm. Too many people fell in love with liquidity forever and synchronized growth forever.
So is divergence another word for volatility, where it's not going to be all boats floating?
Absolutely. I mean, the big changes in paradigms are the central bank, and second, the return gradually of more normal volatility. And so far, and that's really good news, the markets have navigated that well.
Gabriela, you point out that globalized growth, and particularly U.S. growth, has been pretty good. We're going to get that number for second quarter GDP at 8:30. Right now, it looks like the consensus number is 4.4%. This is a backwards-looking number. They're going to revise first quarter, but what should we be looking into in these numbers to glean a little bit about what to expect?
So for what it's worth, our estimate for 8:30 today is 4.8%.
Wow.
And I think it's really, but we wouldn't be surprised with anything between 3 and 5%. Okay. So there is a lot of uncertainty there, especially because of the comprehensive revisions, as you mentioned. What's interesting is the breakdown of that number, right? If we look at domestic demand, so consumption, investment, government spending, we estimate that to be growing around 3.4%. So that extra 1.5% or so is actually coming from a very weird change in net exports to quite a surge in exports in the U.S. that we think is probably related a little bit to the change in the corporate tax code. Maybe businesses are more willing to recognize goods that are actually not actually abroad. And as well, perhaps...
Oh, just because they were penalized for it under the tax code
for having it before. And then perhaps also trying to get some goods out of the U.S. before any sort of tariffs take place. So I think it's artificial.
Well, those are two different things. I mean,
yeah, they are two different things, but
one is channel stuffing
at the same time.
And one is, okay, we're actually changing the way we recognize things because of this tax change.
Correct. But two forces that perhaps may be acting on the second quarter, but are largely temporary forces, right? That we can't expect this pace of growth in the second half.
Where are you for the year as a whole?
So for the year as a whole, we think 3%. For the next 12 months, we think we can sustain that pace. And then ultimately, we actually do find that to be a bit of a sprint, right? Actually, what we consider potential is still much closer to 2%, actually 1.75% growth.
So that's the key issue. I think that's, whether this is a sprint, as Gabriela says, or this is a move to a higher average growth rate.